Hey everyone, and welcome back.
Yeah, welcome back.
Ready to unlock the secrets of smart investing.
Absolutely.
We're about to do a deep dive
A deep dive.
into William J. Bernstein's The Four Pillars of Investing,
It's a good one.
which we hope will help you build a solid financial foundation.
A roadmap, you could say.
Exactly.
So we'll be going over the key principles today,
Right.
exploring how they've played out through history.
Yeah, and hopefully avoiding some common pitfalls along the way.
That's the goal.
Right.
Help people make better decisions.
So Bernstein kicks things off with his four pillars,
Mm.
right? Theory, history, psychology, and business.
Yep. Think of it like a checklist.
Yeah.
A checklist for investing success.
Love it.
So let's start with the first pillar, theory,
Okay, theory.
which focuses on the relationship between risk and reward.
Okay.
And this is something that I think a lot of people misunderstand.
Oh, yeah, for sure.
And this is fundamental to investing.
Yeah, because we've all heard those promises, right? High returns with no risk.
Too good to be true.
Like, what's the cap?
Yeah, exactly. So Bernstein emphasizes that higher returns
Right.
always come with higher risk.
Okay.
There's just no way around it.
Makes sense?
There's no free lunch.
Yeah, no free lunch.
He even tells this funny story in the book
Okay.
about a broker
Uh-huh.
who claims to know a stock that's guaranteed to skyrocket.
Oh, really?
Yeah.
Okay.
But his point is, if they truly knew that,
Right.
they wouldn't be sharing it.
They'd be on a beach somewhere, right?
Exactly. They'd be sipping margaritas on a beach,
Yeah.
having invested everything they had in that stock.
Why would you tell anyone else?
Exactly. So it's a good reminder
Yeah.
that chasing those hot tips or guaranteed returns,
Yeah, those hot stock tips.
yeah, it can lead to some serious financial sunburn.
Yeah, that makes total sense. So how can we apply this to our own investment decisions?
Well, I think it's about setting realistic expectations
Yeah.
and not falling for the hype. You know, if something sounds too good to be true,
Right.
it probably is.
It probably is.
So that's kind of the takeaway there.
Okay, so theory lays the groundwork.
Yeah.
But history shows us how these principles have actually played out
Right.
in the real world.
Exactly. And, Bernstein, he argues that financial history is like a crash course
Okay.
in market psychology.
Interesting.
It reveals that markets and investors,
Yeah,
they can
bad.
be irrational.
Well, yeah.
And this often leads to bubbles and crashes.
Oh, yeah, like the dot-com bubble.
Exactly. The dot-com bubble, the housing crisis,
Yeah.
these are not the first and certainly not the last
Right.
examples of market mania.
Right.
And by studying these patterns,
Yeah.
we can hopefully recognize when things are getting out of hand
Okay.
and avoid repeating those same mistakes.
So learn from the past.
Exactly.
Okay.
Learn from the past and don't repeat it.
And speaking of the past, Bernstein takes us way back in time, right?
He does way back.
With some fascinating historical examples.
Yeah.
Like the Venetian Prestiti.
The Venetian Prestiti.
Essentially, bonds used to finance wars in the 1300s.
That's right, in the 1300s.
Who knew?
Yeah.
Okay.
These things have been around for a while.
Wow. And just like modern investments,
Uh-huh.
their prices fluctuated wildly
You do? Wow.
based on wars and interest rates.
Yeah, based on what was happening in the world.
So fascinating.
What's fascinating is that this shows the link
Uh-huh.
between risk and reward
Okay.
has been around for centuries.
Wow. So it's like that saying,
What is it?
that the more things change, the more they stay the same.
Oh, yeah, I like that one.
Even in the 1300s, people were trying to balance
Yeah.
risk and reward.
That's right. Yeah, it's a fundamental human thing.
Okay.
Bernstein also highlights English consols,
Okay. English consoles.
which were essentially bonds
Okay.
that paid interest forever.
Oh, wow. Okay.
Forever.
So you buy this bond
Uh-huh.
and it just pays you interest.
Till the end of time.
Wow.
And in 1897, at the peak of the British Empire,
Okay. Peak of the British Empire.
console yields hit a record low
Okay.
of 2.21%,
Wow.
which is a fascinating connection, I think,
Yeah.
between finance and history.
Yeah. So what happened?
Well, after World War I,
Okay.
after World War II, rather,
Okay.
with rising inflation,
Yeah.
those long-term bonds
Uh-huh.
started looking a lot riskier.
Okay. Yeah. Inflation changes things.
Right. It highlights how economic conditions can really drastically shift
Yeah.
that risk landscape,
For sure.
even for seemingly safe investments.
Okay. So that brings us to the third pillar.
Yeah.
Psychology.
Psychology.
This is where it gets personal.
Uh-huh.
This is where it gets personal.
Because Bernstein dives into behavioral finance.
That's right.
How our own emotions and biases can sabotage our investment decisions.
Yeah, our own psychology working against us.
I think we've all been there,
I think we all have.
like chasing that hot stock tip or...
We're panicking when the market takes a dip.
Oh, yeah, those emotional roller coasters.
Uh-huh.
Bernstein points out that we often overestimate our ability to pick stocks.
Okay.
And we get caught up in the hype
Yeah.
during bull markets, and we sell out of fear.
Yeah, fear and greed.
Exactly. Fear and greed driving our decisions.
Oh, man.
And that's not a good recipe
Yeah.
for success.
So how do we avoid letting our emotions take the wheel?
That is the million-dollar question.
Yeah.
Well, I think it's about being aware of these biases.
Okay.
Having a plan.
Right.
And sticking to it.
Sticking to the plan.
Yeah, emotions are going to come up. But if we can have a plan in place, we're more likely to make rational choices.
Okay, so we've got theory, history, psychology.
We're moving through the pillars.
What about business?
Oh, yeah, business, the fourth pillar.
This is where things get a little less warm and fuzzy, I feel like.
Yeah, this is where Bernstein doesn't really sugarcoat it. He states that the investment industry is not always your friend.
Okay.
Brokers and fund companies are often motivated by their own profits.
Makes sense.
Not necessarily your best interests.
It's like that saying, right? Follow the money.
Exactly, follow the money.
Okay.
He highlights a surprising fact. Unlike other professionals, like lawyers, stockbrokers don't have a fiduciary duty to their clients.
So they're not legally obligated to put your interests first.
That's right.
Wow. Okay. That's pretty shocking.
It is, and this is something that I think a lot of people aren't aware of.
Yeah, for sure.
So how do we navigate this potential conflict of interest?
Yeah, how do we navigate that?
Well, I think it's about being informed.
Okay.
Understanding how the industry operates.
Okay.
We need to be wary of those who promise unrealistic returns or push products that might not be suitable for our needs.
Okay.
Bernstein really wants to empower investors
Yeah.
with the knowledge to make informed decisions and to protect themselves.
So be informed to protect yourself.
Exactly.
Okay, so we've covered the 4 pillars.
We have
theory, history, psychology, and business.
the 4 pillars of investing, according to Bernstein.
And Bernstein argues that we need all 4 to truly succeed as investors.
I think that's right.
But how do we actually put these principles into practice?
Right. That's the next question.
Like, how do we know what to invest in?
Well, he introduces a powerful tool in the book to help us understand how to value investments. Called the discounted dividend model, or DDM.
Okay, the DVM.
The DDM.
I'm already feeling a little lost.
Okay, well, let me break it down.
Yeah, please break it down.
So think of it this way.
Okay.
The DDM says that a stock's value is based on all the future income it's expected to generate.
Okay.
Those dividends brought back to today's dollars.
Okay.
So it's like figuring out how much a delayed trip to Paris is worth to you right now.
Oh, interesting. Okay.
Would you pay the same price for a trip you can take today versus a trip 5 years from now?
Probably not.
Probably not, right? Because there's a time value to money.
Right.
And the DDM helps us do the same thing with stocks.
Okay.
It brings those future dividends into today's dollars, giving us a way to estimate their present value.
So it's not just about what a company's doing today.
No.
But what it's likely to earn in the future.
Exactly. That's the key insight. And this is how sophisticated investors think.
Yeah.
They're not just looking at the current price.
Right.
They're trying to estimate the long-term value of a business.
So the DDM is the core concept.
Right.
But Bernstein then introduces a simplified version.
He does.
Called the Gordon equation.
The Gordon equation.
Okay.
Which can be used to estimate long-term stock market returns.
Okay, so the Gordon equation can estimate long-term returns.
Yes, that's the idea.
That sounds pretty valuable.
It is a very useful tool, and it leads us to a crucial question.
Okay.
What does the Gordon equation tell us about current market conditions?
Right.
And what it means for your potential returns?
Okay. I'm intrigued.
I think you might find the answer surprising.
Ooh. I like surprises.
We'll get to that next time.
Stay tuned.
Stay tuned. Well, based on current market data,
Yeah.
things like low dividend yields and moderate growth expectations,
Right.
The Gordon equation suggests we might be in for a period of lower long-term stock returns compared to the historical average.
Okay, that's not exactly what I wanted to hear.
Yeah, I know it's not the most exciting news.
But, I appreciate you being straightforward about it.
Well, it's important to be realistic, right?
Yes, set realistic expectations.
Absolutely. Understanding potential returns,
Right.
even if they're lower than we'd like,
Yeah.
it helps us make informed decisions.
So we can adjust maybe our savings goals.
Right, exactly.
Or explore different investment strategies.
Right.
Maybe we need to be a little more patient with our investments.
Right. Yeah. Okay, so stocks maybe not looking so hot right now.
Yeah, potentially lower returns than we're used to.
What about bonds?
Bonds.
How do they factor into all of this?
Well, that's where things get interesting.
Okay.
Bond returns are generally more predictable.
Okay.
Their current yield often gives you a good idea of their long-term returns.
Okay, that sounds a bit more straightforward.
It is, relatively speaking.
Okay.
And here's a surprising fact.
Okay.
Right now, bond returns are expected to be similar to stock returns.
Oh, wow.
Which is quite unusual historically.
Okay, so does that mean we should shift everything to bonds?
Not necessarily.
Okay.
It's about finding the right balance, right?
Right, yeah.
For your individual goals and risk tolerance.
Right.
But it does highlight the importance of considering all your options and not making assumptions based on past performance.
Okay, so speaking of outperforming, let's talk about beating the market.
Beating the market, the holy grail.
Is it even possible, or is it just a pipe dream?
Well, Bernstein uses this amusing analogy to illustrate this point.
I like analogies.
It's the chimpanzee analogy.
Okay, chimpanzee analogy. I'm intrigued.
So imagine a group of chimpanzees managing money
Ready.
by throwing darts at a board full of stocks.
So they're just randomly picking stocks.
Exactly. It's a fun way to illustrate
Yeah.
the concept of randomness in the market.
Okay, I can see that. Yeah.
And even with this random approach,
Yeah.
some chimps will inevitably outperform
Just by pure chance.
just by pure chance.
So it's possible to get lucky,
You can get lucky.
but can you consistently outperform?
That's where the analogy gets really interesting.
Okay.
When you factor in fees and expenses.
Right, those pesky fees.
Yeah, those charges that eat into your returns.
Yeah.
The odds of consistently outperforming the market dwindle dramatically.
So even if you have a few lucky throws, those fees can really drag you down over time.
They add up over time.
Yeah. Okay.
And this isn't just hypothetical.
Right.
Bernstein dives into decades of research on mutual fund and pension fund performance. And the evidence is pretty clear.
Okay, what's the evidence show?
The vast majority underperform the market.
Really? Even the pros?
Even the pros, with all their resources and expertise, they struggle to consistently beat the market.
It's hard to believe.
It is, but there's a groundbreaking study from 1964 by Michael Jensen that showed that active management often underperforms.
So this has been known for a while.
Yeah, and this finding has been replicated in countless studies over the years.
So if the experts have such a hard time, why do so many people believe they can beat the market?
It's a common misconception that with enough research and skill, you can outsmart the market.
Right, pick the winners.
Right, but the data tells a different story. And it raises an important question.
Okay.
If trying to pick winning stocks is so difficult, what's a more effective approach?
Well, that's what we're here to find out.
That's what we're talking about.
Right. And Bernstein seems to be a big proponent.
He is.
Of index fund investing, right?
Index funds, yes.
Okay, so tell me about index funds.
So instead of trying to beat the market, index funds aim to match it.
Okay.
They track a specific market index.
Like the S&P 500.
Like the S&P 500, exactly.
Okay.
So you're essentially buying a diversified basket of stocks.
Okay.
That represents the overall market.
So it's less about finding those hidden gems.
Right.
And more about capturing the overall market growth.
Exactly. You're riding the wave of the market as a whole.
And because index funds are passively managed, meaning they're not constantly buying and selling stocks.
Right, lower term.
They have significantly lower fees.
Significantly lower fees.
Than actively managed funds.
Yeah, and those lower fees can make a huge difference.
Okay.
In your returns over time.
So it sounds like a pretty straightforward and efficient approach.
It is. It's a proven strategy for long-term success.
Okay.
Bernstein compares it to the tortoise and the hare.
Oh, yeah. Slow and steady wins the race.
Slow and steady wins the race.
Okay, but I'm sure some people would argue
Sure.
that index funds will underperform in certain market conditions.
Yeah, there's always that concern.
So what about those concerns?
Well, it's true that in any given year, there will always be some actively managed funds that outperform.
Right.
But as we've seen, that outperformance is often due to luck rather than skill.
Right.
And it's incredibly difficult to predict which funds will be the winners year after year.
So you might get lucky for a year or two.
You might.
But over the long haul, those high fees and the difficulty of consistently picking winners can really erode your returns.
It can really eat into your gains. Bernstein cites numerous studies showing that over the long term, the vast majority of actively managed funds underperform their benchmarks after fees. And this holds true across different market conditions.
So bull markets, bear markets, it doesn't matter.
Doesn't matter. The data is pretty consistent. So it seems like for most investors, trying to outsmart the market is a losing game.
Yeah, I'm starting to see that.
And it brings us to another important concept. Asset allocation.
I've heard that term before.
Yeah, it's a common one.
But I'm not entirely sure what it means.
So essentially, it's about deciding how to divide your money among different asset classes.
Like stocks, bonds?
Stocks, bonds, real estate. Even commodities.
So it's not just about choosing individual stocks or bonds. But about creating a mix.
A mix of different investments.
I see.
The goal is to create a portfolio that balances risk and reward according to your individual circumstances and goals.
So where do we even begin with this?
Well, it can seem daunting.
It does.
But Bernstein offers some helpful frameworks.
I like framework.
For example, he introduces the concept of a lazy portfolio.
A lazy portfolio. I like the sound of that.
It's a simple and diversified portfolio that requires minimal effort to manage.
Lazy portfolio, sign me up.
So it might involve investing in a handful of index funds, covering a range of asset classes.
So U.S. stocks, international stocks.
U.S. stocks, international stocks, bonds.
Bonds.
Maybe even real estate.
So a little bit of everything.
A diversified mix that can weather different market conditions without requiring constant tinkering.
So it's a set it and forget it approach.
Essentially, yes. But even with a lazy portfolio, it's crucial to understand your own risk tolerance. How comfortable are you with those inevitable market fluctuations?
Yeah, because there are going to be ups and downs.
There will be. How much risk am I willing to take?
And how much risk are you willing to take to achieve your financial goal?
So we all have different comfort levels when it comes to risk.
Absolutely.
So there's no one-size-fits-all approach to asset allocation.
It's a deeply personal decision.
So we've covered the 4 pillars of investing.
We have.
The DDM, the Gordon equation.
We've covered a lot of ground.
The efficient market hypothesis.
Yes.
The idea of passive investing with index funds. And asset allocation.
That's a lot to process.
Yeah, it is a lot. It's like learning a whole new language.
It is.
But there's one more crucial piece to the puzzle that Bernstein explores. The investment industry itself.
The industry.
And we talked earlier about how the industry isn't always aligned with the best interests of investors.
It's not always a perfect alignment.
So what are some specific concerns?
Well, Bernstein dives deep into this dynamic.
Exposing some of the hidden fees, conflicts of interest and sales tactics that can really erode your returns over time.
So we need to be extra vigilant.
We do. Bernstein argues that understanding how the industry operates, its incentives and potential pitfalls is essential for protecting ourselves and making sure our money is truly working for us, not for the fun companies and brokers.
Well, so it's about becoming informed and empowered investors.
Exactly. That's what Bernstein ultimately aims to do. Empower us.
Empower us.
To make informed decisions about our financial future. He wants us to understand the principles of investing, recognize the potential pitfalls, and choose strategies that align with our goals.
It's about taking control. Of our own financial future.
Exactly.
And as we've learned, that control often comes from understanding. That we don't need to outsmart the market to succeed.
It's not about being the smartest person in the room. It's about making informed decisions. Managing risk, choosing the right tools for the job, like those low-cost index funds, and a diversified asset allocation strategy.
Okay, so before we wrap things up,
Yeah.
what's the final takeaway Bernstein leaves us with?
Well, he reminds us that we're constantly engaged in a kind of tug of war with the investment industry.
It's us versus them.
In a sense, yes. They're trying to sell us products and services.
Yeah.
And we need to be discerning consumers to win this tug of war. We need to arm ourselves with knowledge. Be wary of those who promise unrealistic returns and focus on building a portfolio that can weather those inevitable market storms.
So he's advocating for a more defensive approach.
He is. It's about recognizing that the market can be a formidable opponent. And sometimes the best strategy is to simply avoid making costly mistakes.
So instead of swinging for the fences,
yeah,
maybe we should focus on hitting singles and doubles.
That's a great analogy. It's about focusing on preserving capital, minimizing losses, and letting those steady gains compound over time.
Slow and steady.
Slow and steady.
Okay, so we've unpacked a lot in this deep dive.
You have a lot of ground to cover.
A lot to take in. It's like learning a whole new language.
It is a new language.
But I think the key takeaway here is investing doesn't have to be a gamble.
It shouldn't be.
Right.
It's not about luck.
It's about making informed decisions.
Exactly. And not chasing those hot tips.
Right.
By understanding the core principles.
Yeah.
You know, the relationship between risk and reward, the power of diversification, and the importance of a long-term perspective.
Right.
We can increase our chances of success.
And even though we focused on Bernstein's 4 pillars, it's just the tip of the iceberg, right? When it comes to investing.
Always more to learn.
There's always more to learn and explore.
Absolutely. And the more we learn, the better equipped we'll be to navigate those complexities of the market and adapt to the ever-changing conditions.
So Bernstein leaves us with a final thought-provoking question.
He does.
Most investors focus on finding the next big winner.
Right. Trying to beat the market.
But what if we flip the script?
Interesting.
And focus on not losing to the market.
Not losing.
Yeah.
It's a powerful shift in perspective.
It is.
Recognizing that the market can be a formidable opponent.
It can.
And sometimes the best approach is to play defense.
To play defense.
Protect our capital.
Okay.
Minimize those costly mistakes.
So it's like that saying, sometimes the best offense is a good defense.
Exactly.
Okay.
It's about recognizing that slow and steady wins the race.
Alarm's good.
Instead of trying to hit home runs, we focus on hitting those singles and doubles, letting those gains compound over time.
So Bernstein really emphasizes having a plan.
Yeah.
Sticking to it.
Discipline.
Right. And resisting those tempting get-rich-quick schemes.
Those are everywhere. It's about discipline and patience.
Discipline and patience.
Long-term thinking.
Right.
Remembering that investing is a marathon, not a sprint.
Marathon, not a sprint.
There will be ups and downs along the way.
Well, yeah, for sure.
But by having a solid foundation of knowledge and a long-term perspective, we can navigate those market storms and come out ahead.
So there you have it. A deep dive into the world of investing.
That's right.
Guided by the insights of William J. Bernstein.
A great guide.
We've explored the 4 pillars.
Yeah.
Theory, history, psychology, and business.
All 4.
And discover how they can help us make smarter decisions.
Absolutely.
And build a more solid financial future.
Knowledge is power.
Knowledge is power, right?
The more you learn about investing, the better equipped you'll be to achieve your financial goals.
Keep learning, keep exploring, and invest wisely.
Couldn't have said it better myself.